Hello, Sector Watchers. Welcome to the show. This is the 126th episode of Sector Spotlight for Tuesday, the 10th of May, and I'm recording it on Monday, the 9th of May. My name is Julius de Kempenaer, and I'm presenting to you from Amsterdam in the Netherlands. You can see my contact details on the screen. If you want to reach out and get in touch, please feel free to do so. The last two episodes we talked about seasonality. That's always the last Tuesday of the month, and then on the first Tuesday of the month we go over the long-term charts using the monthly bar charts, completed monthly charts for, in this case it was the month of April, for asset classes and sectors. So for this episode I want to spend most of the time going back to our relative rotation graphs showing the rotation of the various sectors and look at that in combination with their individual charts and see how we're doing right now, basically assessing the current state of sector rotation, and also of course have a look at the rotation of the various asset classes. What I'm going to do different this time than you are used to is I'm going to start with the sectors and then look at the asset classes, because I find myself always basically spending too much time in the asset classes and then the sectors get a little underwhelmed. They don't get enough attention. They don't get the attention that they deserve. See how that goes. And then also when there is a little bit of time left, I want to have a short discussion on the use of $1 as the benchmark for stocks, on which I got a couple of questions after the article that I wrote in the RRG blog on which stocks to hold in the Dow Jones Industrial Index in that universe of 30 stocks. So that's the plan for today. Let's get started. Ladies and gentlemen, this is Sector Spotlight. So as I said, we're going to start with a look at the rotation of the sectors in the S&P 500. On the right-hand side, we have the daily RRG, and on the left-hand side, we have the weekly RRG. If we start on the weekly, then the big picture, the bigger rotations are still ongoing. I mean, we have the defensive sectors, utilities, healthcare, staples, all inside the leading quadrant at more or less a positive heading. We have the energy sector still way up inside the leading quadrant. The sector lost a lot of relative momentum over the last 4 to 5 weeks, but is now, or has last week, started to hook back up to the right. We'll have a closer look at that in a minute. And then in the inside, and I think that's an interesting observation, and I started making that a week or two ago, is that inside the lagging quadrant on the weekly RRG, we find discretionary, we find technology, and we find financials. And together, that is at least 50% of the market capitalization. So technology is about 27, discretionary is about 13, and financials is 11, 12. So that is that's a lot of market capitalization. It's a lot of market weight inside the lagging quadrant, underperforming the S&P 500. Because this is a closed universe, that means that by default, a lot of other sectors need to be on the right-hand side, outperforming the S&P 500, and that's what's happening. And then you see that smaller sectors like energy and utilities, they're strongly outperforming, but in terms of market cap, they're a lot smaller than tech, discretionary, and financial. So that's the reason why you see that shift between those groups inside leading and lagging. And then obviously there is also the communication services sector still inside the improving quadrant, moderately moving higher at a very short tail. Compare the length of the tail of communication services with something like financials or energy, and you can see that short tails are stable. They are in this case it's a relative downtrend because it's on the left hand side of the plot, and it's very stable downtrend. Not a lot of power behind it, but gradually moving lower and lower and lower. Now, if we bring in the most recent rotations on the right-hand side here, and let's first talk about energy, so we can take it off the weekly chart and give those a little bit more room to shine. Energy here, we discussed this, mainly moving lower on the vertical axis. So this sector went through a pause because we lost relative momentum, but we did not really lose relative strength. Relative strength is on the horizontal axis, relative momentum is on the vertical axis. So what we see here is that that sector, which is the strongest in the universe at the moment, has lost a lot of relative momentum over the last weeks, but that now has seems to have come to an end. And we can see that when we bring in the daily RRG. And here is a rotation for the energy sector over the last 5 days. That's exactly last week, because I am recording this, actually the US market is not open yet. Usually I'm recording much later in the day. That's not possible for me today, so I'm taking the early shift, which means that the US session of Monday has not started yet. Maybe it's a little bit of a risk, maybe we're missing out on information, but I'd like to think that my analysis is slightly longer term, so 1 day more or less should not really affect my analysis. Now here you see the tail for energy, and you can very clearly see that sharp rotation. So here it's coming through leading, it's starting to lose relative strength. That's basically what's happening here on that weekly tail, just a little bit more enlarged in more detail. So you see that loss goes into weakening, and then all of a sudden, so this is May 3rd, 4th, 5th, 6th, and that's last Friday. You see that very sharp hook back up. Some people call it jackknife, I call it hooks, sharp rotations back up. And you can also see that it is actually a clockwise rotation for the energy sector. And that means that it's now getting back in sync with the weekly tail. So this energy sector is really picking up some strength right now and getting back in sync with the weekly tail. All right, so we've got that out of the way. That means that I can tick off energy here, blow up this graph, and then we can have a better look at the other sectors. Now let me bring in the weak stuff here. So here is discretionary, technology, and financials. Let's get that on the daily. Here's technology. You see that there is that little hiccup on that weekly tail, and that's exactly what you see on the daily, that short rotation. But what you also see is that the distance between those observations is getting smaller and smaller towards the end of the week. We'll have to wait and see how that goes this week. There is the possibility that technology will hold up a little bit longer, and we may see a rotation through leading. But the lack of relative momentum, the lack of power behind this tail, and the position of the weekly tail inside the lagging quadrant make me very cautious with technology. If you go to discretionary, you can see that that has started to move to the left. It's the second weakest if you measure in terms of RS ratio. Look at the daily tail. You see that it is shooting back into the lagging quadrant. We had this rotation on the right-hand side briefly. That's when that XLY tail bounced off that support level in terms of relative strength. We bounced up, and then, well, it's very shortly, and now we're accelerating into the lagging quadrant. So what we saw lacking on the technology tail, where the distance between the observations got smaller and smaller, you see it increasing on the discretionary tail, and that is sending the weekly tail further to the left. And I'm pretty sure that it will continue in the coming week here for the discretionary sector. Now, the third one here is financials. You see financials here at a very nice long tail pushing into the lagging quadrant, signaling weakness from a relative point of view. And we get the same message from the daily. Here we see the financial sector going through a little hiccup, through some improvement, didn't reach the leading quadrant, rolled over. You see that the the tail is shrinking. See that? So here the tail is length, and then all of a sudden it starts to roll over, and you see that tail shrinking, and then it starts to accelerate, expected to accelerate lower this week. And you can see that same process happening with the discretionary. You see that when they turn around, that tail shrinks. So discretionary is already ahead of the game. It's already accelerating lower. And you see that financials, if things continue as they are right now, we'll probably see financials accelerating back into the lagging quadrant, getting back in sync with the weekly tail on the RRG. I'm not going to go over in all that detail with all these tails here. Utilities are still going strong on the weekly RRG, so that's defense is still there. You can see that they're inside leading on the daily RRG. They may, or I'm going to expect them to turn back up relatively soon and get back in sync with the weekly tail. Staples interesting because they hooked back up a little bit earlier already. We saw that in energy, and you see the same setting with the staples sector. And if we look at the daily tail, then you can see that it's now inside the weakening quadrant. That hookup here is already taking place for 1, 2, 3, 4 weeks. So that's about 20 days. So we need to scroll back here to see that happening. This is when that round here, that's when that started to hook back up. And you can see that that's now on the daily losing momentum, going through weakening. That may put a little pause, a little break on the development for the staples sector. But if this continues to rotate in a strong manner and put in a new low inside the weakening quadrant and roll back up, then staples will be back on the forefront again. And don't forget that in terms of relative strength on the daily, staples are the strongest sector at the moment, rapidly followed by energy, and they're probably going to overtake this week, making energy the strongest and then staples second. But it is all pretty much in line with what's happening on the weekly tail. What else do we have? We have the healthcare sector. I think that's probably the hardest one to read at the moment in terms of defense. It's inside leading, but starting to roll over. There's not a lot of power there. But the same is happening in the on the daily RRG. It's inside the weakening quadrant. You can see that the tail is very wrong chart. Tail is very short. So there's still a good chance that it is starting to pick up before it hits lagging and roll back up to leading, getting back in sync with the weekly tails. All in all, you know, healthcare is still in good shape. Not as good as staples as utilities, but still in good shape. And then the last one that I want to mention here is industrials. It is slowly improving. There's not a lot of momentum. You can see that it is very stable here over the last few weeks. And the rotation on the daily been taking place very close to the benchmark. You can see that tail for industrials is on the inside track. All of a sudden, I've got to think of the inside line. That's a program on Formula One racing, but it is actually the inside lane. You know, you can see the other ones are rotating on the outside, and industrials remains on the inside, relatively close to the benchmark, and that's exactly what you see on that weekly tail, picking up a little bit. We got to wait and see how that develops. The big message here is that defense is still in play. They're still inside the leading quadrant longer term, waiting to be getting back in sync with the short-term tails. But more importantly, a lot of market cap from discretionary, tech, and financials is inside the lagging quadrant and moving deeper into it. So where we had the initial warning signals for defensive sectors to lead the market, that is still the case, but it's now getting reinforced by the clear offensive sectors to start losing relative strength and start moving down. So we now have two negative things in the stock market going on, and we'll just have to wait and see how that pans out. But I'm not going to predict a crash. I'm following the market, and I see a lot of weakness in the market. It could be, I don't know, we'll have to wait and see. But let me put it like this. I'm going to turn it around. I don't see a very strong rally emerging in the next couple of days, maybe not even in the next couple of weeks. So let's quickly go to some individual charts to back up what we just discussed in terms of RRGs. Here is the material sector. They're still doing very, very well. There's no problem there. Inside the leading quadrant at a very nice heading, backed up by relative strength from the weekly chart. Here is communication services. As I said, that's still very weak. You see that relative strength continue to go down. You see the price continuing to go down. We tested former support, now resistance, and we closed the week at the lower end of the range. We're getting close to support at 56.5. I'm going to watch that in the coming weeks. Here is energy. As I said, still going very, very strong. It's off the chart here, but you know where it is. And what we saw here is that the breakout level, long-term breakout level, was 64.5. We rallied, we tested it as support, and now we are pushing to new all-time highs. So there's no doubt that the energy sector continues to be very strong. Here is financials, as we just discussed extensively. They are now completing a very heavy top formation on the chart. It's not yet followed by a breakdown in relative strength, but the RRG lines, as you saw on the tail, are already discounting a break and pointing to lower levels. And that seems to be supported by the break in support of price. We go to industrials. That's in the range, still in the range. It's stable. We discussed it. It's stable on the RRG. I would be very careful when this breaks below 92.5. That's probably going to be a very weak signal. As long as we hold here, as long as we hold inside that range, you're probably going to see the tail of industrials rotate very, very closely to the benchmark. Technology at a crucial junction, I think. Wrote an article last week on basically, well, on sector rotation, but focusing on technology and discretionary, and I said that 140 and 160 are crucial levels to watch. And for technology, that's the 140 level, and we are pretty much exactly there. Relative strength continues to be weak. The tail moving further to the left. It's a bit of a call here because at 140.57, 140 is still holding. I want to see a very clear-cut break at a Friday close lower, and it could very well be this week. Watch this level, watch this support area in technology. If that goes, then technology is seriously at risk and expected to push further into the lagging quadrant. Here is staples continuing to do well. We saw the chart, we saw the tail. No problem there. Here is real estate. That is now resting at support. Seems to be putting in a toppish pattern. From a relative perspective, it's still okay-ish. We're resting at a former former resistance level that's now acting as support. Our G lines are okay. We're losing a little bit here. I would say levels around 44 are crucial. There's support nearby, 42. The area between 40 and 42, but we're losing a little bit of strength in real estate. Here is utilities. Threatened to drop back below the breakout level last week, but at the end of the week it managed to get back and stay above, so that level has held up, and so that the move in relative strength, so that is a good thing there. And we have utilities. Here's utilities, pushing nicely further into the leading quadrant. We quickly go to healthcare. As I said, hard to read, bit volatile, no very clear support resistance levels. The break in relative strength is clearly there, so that's the good news. It's still inside the leading quadrant, moving higher, so it continues to outperform the S&P 500, being part of the defensive rotation. And then finally, here we have the consumer discretionary sector. And again, that was the 160 level that I was talking about. And here we've got 158. This is a much more pronounced break than we saw in technology. And you also see that happening here in the relative strength chart. This is a pretty clear break. So discretionary, I think, is now leading the way lower. both in terms of price and in relative strength. And here we are, 20 minutes into the show and still 2 items to cover, so I need to speed up. It's a good reason I started with sectors first. Weekly RRG on the left, daily on the right for the asset classes. We're going to go really fast. Commodities remaining very, very strong, and you see the rotation on the dailies for DJP and GSG hooking back up, getting back in sync. So commodities are back in play. They remain a strong, if not the strongest asset class. Another strong asset class, if you wish, is the US dollar. US dollar strength continues. It's very, very clearly visible, especially also when you look at the euro dollar chart, which continues to drop very, very rapidly. The other thing that I wanted to show you, highlight you, is the weakness of real estate, V&Q. We already saw that in XLRE, and you can see that it's rolling over last week on the weekly tail, and you see the acceleration towards lagging on the daily. So there's a minimum of a pause in terms of real estate. If we quickly go to SPY and government bonds, then you see that there is a preference, a good move for SPY, and that comes back in the daily RRG, where SPY is inside lagging but curling back up, and the fixed income ETFs are rolling down. Again, this is very, very important to realize. This is all based on relative strength. So even if SPY comes out on top of GOV and IEF and the other bond ETFs, that doesn't mean that SPY will be going up. It just means that SPY is going down less than the bond market. And I think that it remains an important message that bonds are still very weak. We've reached our price target based on the big head and shoulders for both IEF and GOV. And we'll have to see what happens. We're reaching some pretty critical support levels in bond prices and resistance in yields. But it doesn't look really good for the bond market, and that'll very likely have an effect on the stock market. Nevertheless, SPY seems to be less bad than bonds at the moment. Quickly go over some charts. Here is the euro dollar chart. As I told you, we now broke 106. We're at 105, and we're rapidly heading for parity. That's €1 for $1 US. Dollar strength across the board, I would say. I wrote a Chart Watchers article for that last weekend. Here is SPY. We're resting at 410. I think 410 for SPY is a crucial level to watch. If that breaks on a weekly scale, then we are going to see another leg lower. Based on the height of this pattern, it's about 50 points, 460 to 410. We can project that below a breakout level of 4.6. That gives us levels around 360, 365, which is where we had a cluster of highs and lows back around the transition from 2020 to 2021. I can't make it any prettier than it is at the moment. That's what it is. There are definitely some pockets of strength left and right, but in general, remain very, very cautious with the stock market. Just very quickly, as a reminder probably, after my article on which stocks inside the Dow are worth holding, I got a couple of questions on the use of the $1 benchmark. What I did here is I started out with looking at the Dow components against the Dow Jones Industrials, as we usually do that in relative rotation graphs. The problem is that we are in a weak period of the markets, so markets are going down, and basically that means that we're comparing the members of a universe with a benchmark that's also going down. And that's good if you're an investor that needs to beat the benchmark, and that's all good because your portfolio will eventually be holding stocks that are outperforming the benchmark. And even if that means that your portfolio is going down, you're beating the benchmark. And for professional investors, that's exactly what they need to do. For a lot of retail investors, that's not really necessary. You can go to cash if you want to. And that's a very, very big advantage for retail investors. You can go to cash. You don't have to be invested like a lot of professionals. And that's where the $1 benchmark comes in, because $1 compares the components of a market with a flat line, with the baseline, with absolute price performance. And if you do that, you will find stocks that are outperforming the zero line, so which are actually raking in absolute price performance. The questions that I got was, is $1 better? Is it better to use $1? I don't really know. It completely depends on your personal situation. But if you're a retail investor and the market's going up and you want to beat that market, you need to use the benchmark like SPY or the Dow Jones Industrials, because you'll find stocks that are outperforming the market. If the market's going down and you don't want to lose money, then it's better to use $1, because you will only find stocks, you'll spot stocks on the RRG that are outperforming, or at least going for a positive performance. They're outperforming absolute price performance. I know it's a short explanation. I may write another article about it, but I just wanted to give it to you. And that wraps up Sector Spotlight for this week. Thank you for watching, and please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to see you again next week at a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.